So maybe a little bit about me. Some of you know me already in different contexts and things like that. I've been working in the nonprofit sector for 22 years now. Not something I thought of at school I would ever be interested in, didn't even know it existed. I just wanted a nice bookkeeping job at Zio. As some of you know Zio, it used to be called CMDS. And within 6 months, I was pushed out into the township to go and get some books that I'd never crossed the railway line, and I really exposed me to things and pushed my boundaries, and I realized that this is a world that makes such a difference, that has such an impact, that I could use my skill set to actually change people's lives and help organizations to be sustainable and continue the work that they're doing and to maximize the impact that they're having and reach their full potential. So I got hooked, so stayed in the sector for the 22 years. About 13 years ago, it had always been a passion of mine to start my own company. So I finally had the courage to do that. And then a few years later, Bruce, who's also on the, is kind of hosting this for us, and I partnered up and joined our companies to be able to offer a broader range of support to small businesses and nonprofit organizations. So our company focus, my focus, has traditionally been on financial management and the financial aspects of an organization. And in the last few years, we've actually started to expand that beyond just the financial aspects into all areas of management and being able to support the organization as a whole. So that's really our passion, to really see that potential of the organization. And finance is such a critical golden thread that flows through everything that an organization does, that I will always have a soft spot for it, but it's not the only thing. And so we need to see the organization as a puzzle and how all of the pieces fit together. So that's where we're at. And this masterclass is part of, I want to say an offering is probably not the right word, but that we're fleshing out to be able to support finance managers. Because if you don't have that function operating effectively, then it has an impact on the organization as a whole. So I'll talk a bit more about that later on as we wrap up. Today we're going to cover sort of 5 main areas. We'll see how fast we need to go through them and how much time we have. The one is looking at organizational structure, how we see it, how we see the role of the finance manager, so that we can put this conversation into context. Then we're going to have a chat about funds and reserves on the balance sheet, then look at donor balances and how those are presented on the balance sheet, and then we're going to look at how do we actually calculate those donor reserves, donor balances. So that's kind of a broad structure of where we're going, so you have some context. Okay. So Bruce and I have developed the concept of the hamburger, organizational hamburger, and it started off as a sort of a semicircle at the top, a circle in the middle, and a semicircle at the bottom. This was our graphic that we were trying to explain how an organization fits together. And I was in a meeting with somebody trying to explain it without having the picture in front of me, the diagram in front of me, and I was like, it's like a hamburger, right? With the cheese in the middle that sticks it all together. And so then next meeting, Bruce shows me this picture, and I'm like, that's our organizational picture. We're going to hold on to the hamburger because that looks so juicy and so, so perfect. When we unpack the organizational hamburger, it looks like this. Okay, I hope it's big enough for you to see. I'll just talk about it a little bit. So there are 2 parts to an organization, and I'm speaking about this in somewhat generalized terms, but also when you're really small, it's difficult to see how these are separate functions And so you might find that you've got one or two people who are sitting in all areas and wearing different hats. But it is important to also see that there are different hats. So the top section that we look at is organizational culture. Okay, it's the strategic aspects of the organization. It's the section of the organization that looks at why do we exist? What is our purpose? What is our vision for the organization? What is it that we actually are here for? It's the section that says, well, who's going to do that work? How do we do it with each other? What is our organizational culture? What is our values? What are our ways of being? And it looks at the practical, like, how are we going to outwork this? What is our long-term strategy? What are our plans for the future? So that's the top layer of the hamburger. It's that organization-wide culture. The bottom bun of the hamburger, which I've just realized often gets squashed and soggy when you have a real hamburger, and in some respects the operational culture often gets squashed and the pressure is on to make the vision happen. So the operational culture is the nuts and bolts, it's the engine room, it's the side of the organization that implements what is planned as the organizational strategy. And so you're looking at things like, what are the outcomes? What are the specific things we have to deliver on? What is the policy that govern how we do our work? So when you look at operational stuff, you don't talk strategy, you talk policy. It's very practical. This is the way of being. And then the procedure. Step 1, step 2, step 3. That's how we actually implement the plans. And so you'll have the strategic leadership who is engaging with the operational organizational culture, and you have operational leadership, which looks at the operational culture. And when you're really small, and I think Lana's going to look at me and go, you have to wear both of those hats, right? You have 2-3 people who are doing both operational and organizational. And you might in one meeting go from the one conversation to the other conversation. But it is helpful to actually see them as 2 specific things. One of the strengths that we have identified in our company as well is where we personally lean towards, right? Some people are visionaries and they're big picture thinkers and they think outside the organization and they're thinking, wider. They would lean towards that organizational culture. There are other people who are more detail orientated and structured and systems focused, and they would lean towards that operational culture. So if you're the one lone person sitting in the middle, your personality will determine sort of where you're leaning towards and which focus area you'll spend more time in. And so finding a team, whether it be employed team or support like an organization like ours, to bring the other side of that, to balance that conversation, helps you as an organization to actually reach potential, because you're not stuck focusing on just the leader's area of expertise. So fleshing out that leadership team. So you end up with your strategic leadership focused on ideation and your operational leadership focused on the implementation. The red band was kind of in the middle of everything in our initial drawing, but it ended up being the cheese, because the cheese glues everything together, right? If you ever tried to take a hamburger patty apart, and if you have a cheeseburger, the cheese is glued to the bun to the patty, and you can't. And the cheese is the communication, right? There has to be a clear communication throughout the organization. It has to flow from that strategy, from that strategic perspective, all the way down to operations. This is where we're going. This is what we need to do. How are we going to achieve that? And then the flip side is also true. Operations needs to say, this is not working. We can't track this. You're wanting to create this M&E system that requires everybody to be doing more data collection than actual work. It's not functioning. That feedback communication has to be there. It has to be that loop so that whether it be the cheese that sticks it together, the glue, the oil that smooths everything, however analogy you want to use, that communication makes the stuff work, and it's a very important part of it. Some of it can be informal and but others needs to be actually structured communication and formalized processes. And so building in that learning cycle, building in that communication loop, making sure that that is clear is a very important part of making the organization hamburger edible. Okay, so then where does that put us as finance people and finance management? So there are two potential areas, and sometimes you have to straddle both, right? The most common understanding is sitting in the operations, okay, where you are focused on ensuring the finance manual is up to date and you're following the procedures, and it's all about, compliance, where you're focused on procurement and making sure that that process is happening. You've got 3 quotes and you've got all the things that you need in order to meet your procurement thing. You're looking at the historical record keeping and, reporting on what has happened so that you're then able to see, okay, where we're at this point in time. So there is that comfort level where a large percentage of finance-related people feel the most at home, where you're dealing with those details and that consistency of knowing I'm explaining reality because I'm dealing with the past and what has actually transpired. And then there's the strategic leadership role of the finance manager. And often as an organization grows, they reach a critical mass point where that strategic leadership of the finance manager becomes more and more essential to actually seeing the organization flourish. And that kind of role is where you're looking at the long-term financial strategy. So you're looking at these conversations like we're going to have today about reserves and about funds and balances and things like that. You're looking at what do we do with that? Where are we going? You're looking at growing the passive income. You're looking at forecasting. So scenarios, forecasting, strategizing, looking at the financial function and seeing, okay, what is the strategy that we need to employ to ensure that this financial function is fit for purpose as the organization grows into the future? What are the systems that we need to improve and adapt? What are the documents we need to put in place and the templates and things like that? So you're looking at future growth, you're looking forward, you're working a very uncertain area because there's so many variables, but you're taking what you know historically and projecting into the future and adding value to the strategic leadership by being able to say, well, if we go and start that whole new area or move to a different geographic location, these are the financial implications, and being able to add that valuable financial conversation to the strategic conversations within the organization. So our speciality is really working with growing organizations, and we have what we kind of call the stone in the shoe issue, where what was working no longer works. So you grow and everything's fine, and there's a critical point at somewhere along the way that something's not working so well, right? And then what you're saying about tapering off a little bit, putting those systems in place for the new organization that you are and the organization that you're going to become, getting that foundation in place is really good, because then it leverages you up for the next growth phase, and so that you don't end up unraveling because you're actually growing bigger than your systems and your structures and things like that. I think just to add on to that, there is by nature so much of our work that is detailed and is historical and things like that. And when that becomes all absorbing because of the deadlines and the commitments, it's very hard to stop and lift your head up and look forward. And so sometimes it means that you actually have to split roles into, you have different people doing different things because it's difficult to straddle that over the long term, especially as the organization grows and you end up spending more time catching up and keeping on top of it every day. So I want to just share for a minute how we engage with the Hamburger as a company. And what support we offer to management and to the teams. Particularly, we find that organizational culture struggle to set aside time to engage, to do like blue sky thinking, to do those stuff. And then you end up, there's a horrible phrase about drinking the Kool-Aid. Okay, if you don't know what that means, go Google it. But when everybody is thinking in the same patterns and you've all been in the same organization for too long and none of you can think beyond what your experience is and bring something completely new to the table. That's an opportunity for an outside consulting firm, for an outside facilitator to come in and challenge your assumptions, the things that you've just believed about your organization and didn't realize that actually they needed to be assessed. Challenging assumptions, sparking that creativity. So often we can't see our own blind spots. So somebody else being able to identify the gaps really helps people to clarify their thinking. So that's a role that we can play for an organization. Then coming down to the very bottom is the operational culture, where you're looking at, okay, I've got this big project. I have no idea how to take the 5-year strategy and make it into practical actions that we as an organization can implement. Looking at improving efficiencies, establishing structure, support and documentation. How many of you have had update finance manual on your to-do list for the last 2 years? It's one of those things that nobody ever gets to. It's always on the to-do list and nobody ever wants to do it. Supporting documentation of things is something you can get an outsider to help you with. It's one of those like not urgent at the bottom of the list kind of things that never gets done. So those are the ways that an outside organization can provide some support. And then in terms of that communication and the oiling the wheels, having an external person engage with the organization allows them to facilitate collaboration, be that facilitator, have all the people in the room in conversations, capture what's actually been agreed. It's very difficult when you're thinking creatively, discussing stuff, to actually also then sit down and actually write it yourself. Support clear communication and initiate cyclical learning. So those are ways that we can support that organization in order to make sure that all the pieces work well together and that you are really meeting your full potential. Interestingly enough, when I was thinking about this topic, I didn't link the association between funds as in income coming in. So I totally hear you on that. That's great. I think what is often confusing is when you have a balance sheet, and sometimes it says accumulated funds, and then you have specific funds, and you have, balanced funds and things like that. And then other times you have accumulated reserves and, specific operational reserves. And I've often asked, what's the difference? Why do we have funds? When do we have reserves? When is it what, all that sort of thing. So I try to find a definition. And this was quite an interesting exercise. So I'm thinking, okay, I'll just go to the International Accounting Standards and it'll be very specific. When you record like this, you do this and this, and no, it wasn't. So this is what I could find for reserves, okay, just reading very quickly, the use of the term reserve is limited to amount that, though not required to meet a liability and contingency, has been apportioned from retained earnings. So this is basically what you're saying. We've taken a piece and we put it aside at the discretion of management and according to a requirement of a law of some kind. Okay, so that's our kind of common understanding of reserves. Then I was like, well, what is funds? And now we have a third definition of funds, because there's your definition in terms of like income grant funds, there's my definition, and there's this one, which, here we go, is a fund is a self-balancing set of accounts with assets, liabilities, and a fund balance. I was like, okay. Funds show ownership of cash and fund balance and are distinguished by their source of revenue. Okay. Then a fund is a pool of money set aside for a specific purpose. Okay, I'm on the same page here now. But then the pool of money as a fund is often invested, professionally managed, and types of funds are pension funds, insurance funds, endowment funds. And I'm thinking, hang on a minute, this is not on our balance sheet as a line, it's a fund. The whole entity is a fund, according to this definition, where there's income and expenditure, assets, liabilities, and a balance of the fund. So, like, well, that's interesting. So I decided, okay, let me rather put my thoughts down, and you can see if you identify with this, because I think it's quite helpful to see a difference when you are looking at your balance sheet and how you are presenting your financial information. Okay. So my thoughts on funds. All right. So I see funds as a building fund, a motor vehicle or an asset replacement fund. And like you said, those donor funds, the kind of the balance of them, the unutilized portion is what is available as a fund on the balance sheet. And the kind of criteria to consider it to be a fund are things like a specific income source. So we have a donor who gives us an amount of money, and that is the fund that the balance that we are tracking of their money, their fund. Or it's things like we charge mileage on the vehicle, and that is our source of income to our vehicle fund. Or we have a campaign for our building fund. So people are either giving money specifically for that fund, or we have created a mechanism to generate money specifically to increase that fund. So that's what I mean by specific source of income. The other one is that there is a specific purpose of why we've created the fund. We're keeping that money for a particular purpose, and it's often an asset purchase. So a building fund, obviously, things like that, replacing an asset, stuff like that. Okay, and then there are specific conditions for it. So where we have a donor who's given us fund money for a designated purpose, that will go onto the balance sheet as a fund that has to be spent according to the designated donations, right? And this is what often happens when we have lump sums that are given for a building fund. We can't just put that into our money. It has to be ring-fenced. It's often arising out of a strategy or a policy. So we're wanting to expand our premises, we're wanting to expand our asset base, and so we're looking to purchase a building, we start a building fund. There's a strategy for that. Or we have a policy around charging for the use of our assets in order to make income to replace them. There's a policy around that. And sometimes it's shown as a liability on the balance sheet, where it comes in as donor funds or funds that might need to be repaid if the specific conditions of the fund are not met, a designated donation. Okay, so those are my thoughts on funds. Then how does that differ from reserves? Okay. Reserves are typically things like a property or PP&E reserve. operational reserve, sustainability reserve, closeout reserve. These are all names for the same sort of thing, okay? It's a specific allocation of accumulated funds. So over the years, we have accumulated surpluses as a result of passive income, income generation, whatever it is that we have done to build up that surplus that we can actually designate and ring fence as a reserve. And we are specifically ring fencing a portion of it. Now, and this is why this is a masterclass, because we get technical accounting in here, okay? A challenge organizations often have is they will be showing accumulated funds of 10 million, say, right? And then the donors look at that and they go, well, do you need our money because you actually have all this money? But it's not money. What you've done is you've actually used 8 million of that money to purchase a building or multiple buildings. So your asset value is 8 million and your accumulated funds is 10. So the donors and others who don't read the financial statements correctly and can't differentiate, see that accumulated funds as cash available to you. So what a lot of organizations do is they actually create a reserve that is equal to their asset value. So this is what the property PP&E reserve is, where you actually separate your accumulated funds into the 2 million that is potentially cash and the 8 million that is related to the property. So how you have invested those reserves is in the property. So there you're actually splitting out your accumulated funds into a designated reserve in order to show a clear picture of how you have utilized the funds that you have accumulated over time and what is your asset value. The other ones are operational reserve, sustainability reserve. I think various people have different names, general reserve. It's kind of the thing where you're like, well, let's build up as much as we can in order to save for a rainy day, deal with strategic issues, cover a gap in grant funding, whatever that looks like. And that's just taking what accumulated funds you have available that you can spare and separating them out into a reserve with a particular name. One of my clients has actually set up a closeout reserve. So what they realized is if the organization ever enters into a challenging position where there is no further funds coming in, and they decide they actually need to close the organization, you need to have ring-fenced money to be able to actually deal with that process of closeout. Because often you find that organizations keep hoping more money will come in and eventually run themselves so dry they can't pay out retrenchments and they can't pay out the legal fees and all of the other stuff that needs to happen in order to wrap up an organization. So they have decided to separate out a portion that is equal to senior leadership and an administrator, the relevant people they need, for 3 or 4 months, their cost to pay them beyond the end of the organization in order to close it up and wrap it up. So that's what they've decided to designate as a closeout reserve, where they've taken their accumulated funds and specifically ring-fenced it. So with this kind of reserve, it is generally created from surpluses, as I said, where the surplus is created in whatever way, and you actually then deciding we're going to intentionally create a reserve. It's always created by policy. So if you have a reserve on your balance sheet, go and find out where the policy is and what the policy says. And this policy, the spectrum, is from we have a pot of money we can use in any way we want, that we don't have to repay, that is there, to we have to use it on A, B, C, D, and E. It has to be repaid in F, G, and D. It's only allowed to be used for this and that, and it has to equal this value, and da-da. So the policy can be as general and as broad as you like, down to as specific and detailed. And typically there is a repayment clause in the policy. because the expectation is that it is only for a short term. If you are consistently using your reserves to prop up the organization and increase its longevity, then maybe there's a problem with the business model of the organization and the relevance and whether it should continue at all. So the idea is that your reserves are used for something that is strategic. So repaying the reserves. Some people like to set a target for the reserves, where you're looking at 3 months of operational income, 6 months, 12 months, whatever it is that you can afford. And some people set a specific contribution that needs to be made every year. So we're working towards a month of operational reserves be added, of operational funds, cost of running the operations for a month, be added every year. And by the end of 12 years, we would have 12 months worth of reserve. That's quite specific and puts a lot of pressure on the organization to actually generate that kind of income. So it's not common. But whatever it is, the policy needs to be quite clear on how that reserve is created, how it is used, and who has authority over making those decisions. And typically it's the board. So there is also a balancing act between the management team and the board of how much you actually put in the reserves, because you want to sometimes have some flexibility with being able to use funds that you have in your accumulated funds without having to have explicit permission from the board. If your policy is so specific that it can only be used for particular things, then that reduces the flexibility of the leadership team to make strategic decisions quickly and to move into new areas in using the reserves. Okay, the other thing with the reserves is that when it's presented on the financial statements, you would have an actual section that shows the statement of changes in reserves. The last point, and this is quite important, is it should be represented by an asset or an investment. Okay, so a physical asset or a cash asset. Because if your reserves are sitting in your current bank account, there's a couple of problems there. The one is that it is so easy to use it and spend it, and you're not aware that you're eating into this big pot of money that you have. When does the donor fund end, and when do the reserves start that you're utilizing? It's quite easy, especially with historical record keeping, to slip into that and to start spending into your reserve cash before you realize that you've done so. The other one is your reserve should ideally also be an asset that contributes to the organization, so a productive asset. You want to have your reserve in a share portfolio, unit trusts, call account. At least it should be earning interest. At the least, it should be hedging against inflation. Because if you put your cash into, say, a current account, let's say you have R1 million reserve, with the inflation, that R1 million, if it doesn't change, will only be worth 900, I can't do the maths, in 10 years' time. And in that fact, then you're actually eating into the value of your reserves, and you're undermining that, and you have less reserve than you actually thought you had. So ensuring that your reserves continue to grow with hedge against that inflation, they need to be invested in an asset that increases in value. So don't spend your reserves on vehicles. Not a good investment, right? You want to invest it in something that will see a capital growth over time in order to make sure your investments are worthwhile. Okay. So I think that the key thing is, for me, it doesn't matter what you call them, whether they're funds or reserves or operational reserve or sustainability reserve or endowment, or whatever it is. It's very important that you are clear on what is the story that your balance sheet is telling to the readers of the balance sheet, right? We actually need to sit back and look at that and make sure that it is telling the story we want to tell. So often you end up with minimal assets, maybe no liabilities, and then this big fund. So you basically got accumulated funds and cash in your balance sheet. Now that doesn't tell, it just shows donors you've got money to spend. That's it. It doesn't talk about sustainability. It doesn't talk about building the base of the organization. It doesn't talk about what investment you've already made. So one of the challenges we also have is writing off of assets, where you then have no assets showing on your balance sheet. So it looks to a donor, just looking at the balance sheet or a user of the financial statement, that you're a person in a home office with like nothing because there's no actual assets and no actual asset value there. It gives you weight and shows that you actually exist if you have some assets shown there. And they're then reflected with your reserves. So you're actually taking the time to look at the accumulated funds and say, how are we wanting to strategically utilize these funds, where we have them, how do we want to represent it? What are the things that we want to show? How do we want to make ourselves look like a mature organization who's actually taken the time to engage with how our funds are reflected on our balance sheet? So I think that for me is there's a story here. When I look at financial statements on a regular basis, I can tell a lot about the organization just from the financial information that's presented. So it doesn't matter what you call it, but taking the time to actually engage with your balance sheet and see, is it telling the story that you want it to tell, is part of that strategic financial management. Where do we show our donor balances, right? So one of the funds that we were talking about was the balance of funds that we are holding for our donors, okay? Where we have this, there are two situations where we've either not spent all the money that's been given to us in a particular year, and we've been allowed to extend that and to roll those funds into the new year. And the other one is where the donor contract covers our financial year, crosses the financial year. So at the end of the year, we actually have funds available from the donor who's given us funds in advance that need to then be spent in the new year, okay? And there are typically three places that people will record those balances. So it's come into income, whatever spending has been spent, it's now sitting in the surplus for the year. Some people will leave it there in the surplus, and then it shows in your accumulated funds on the balance sheet. Okay, we're really just focused on balance sheet today. When we look at the accumulated funds, we then want to have a note and to break that down. The second one is to have a separate fund, and the third one is deferred income. So let me show you what I mean, and I hope you can see these because these are a little tiny. Okay, so when you have a note to the accumulated funds, it basically looks like this, where this particular organization, they kept their general funds, which would be their normal accumulated funds, out of non-donor surpluses, okay? So passive income or interest or whatever. They've kept that separate and then specified the donor-specific funds that are carried forward, and they've itemized the individual donors so that they are then aware of what balances they're carrying forward for each donor. So what is good about this is it keeps all your surpluses together, right? And separate from other reserves. I actually had a little picture that I took out of this one because it just made it too squished, where this organization has a note number 8, which is specific reserves. And they have a couple of reserves that they have itemized there as specific reserves. So this is separate from the reserves that they have created by policy. So it keeps all the surpluses together. The challenge with it is that you then need to track the opening balance, income and expenditure, and closing balance outside of the accounting system for each donor. Because what you've got at the end is the surplus at the end of the financials, and there's no internal mechanism for calculating these balances. They're just a note based on a spreadsheet. So this is kind of what their spreadsheet looks like, where they have the brought forward from the previous year, income, expenditure, and then the balance carried forward. And that balance carried forward is then what goes into the financial statements. Okay, so that's the one where you actually take the accumulated funds and you break it down with a note. The other one is where you have a separate fund. So this is actually two pictures. It looks like one on here. The top part is in the balance sheet, where you have accumulated surplus. They have a motor vehicle replacement reserve as well, and they have a sustainability reserve. Okay, so they put them as specific reserves within, I should actually say separate reserve and not separate fund. But they've created this separately, right? And so they're showing then in their statement of changes in funds, in reserves, they're showing their individual reserves in and out, keeping that separate. Okay, so that's another way of doing it, showing it as a separate fund. And then the last, oh, hang on, let me just go back to that. So it's very clear then what is specific to that particular reserve, whether it be a donor reserve or donor funds. They don't actually separate out the individual donors, but if you were to separate out individual donors or put the project fund as, all the donors together as a separate fund, then you'd be able to see that shown on the statement of changes in funds. But also, in order to get those balances, you actually need to track it outside of the accounting system. Right. Deferred income. So a lot of people like to show their donor balances as deferred income in their financial statements. So it's very clear what the carry forward is because you can see it in the prior year comparison, right? But when you bring that deferred income into the new year as income, it kind of skews the picture of how much income you actually are receiving in the current year, because the total income is receipts plus that deferred income that you're carrying forward. So it doesn't give you a clear picture of what is the receipt for that particular year, what your budget is from the donor for that year. The other one, I've always had a problem with doing deferred income. I understand the practicalities for individuals, and it helps people to keep it clear in their head and to sort of tie the year nicely, because then essentially what you end up in your income statement is a zero surplus unless you've got own funds, because you've removed all the income that is not relevant to that particular year. The challenge for me is that deferred income is typically shown on the balance sheet as a liability. And that means that there needs to be some expectation of repayment of the donor funds, which for the most part there's not at year end. So donors typically will write into their grant agreement that at the end of the project period, at the end of their reporting cycle, if there are any balances, you either have to reprogram them or you have to pay them back. So there is a liability element at the end of the grant period. But midway through the year, when the grant crosses over the financial year, how do you determine what is a true liability? At that point, it's, whatever funds you have on hand is not expected to be paid back. The donor has no expectation of that. You're going to spend it in the balance of the grant period. It makes sense to me where you received funds in, say, December, and you're like, we're going to not start the grant now. We'll start the grant 1st of January. If your year end is December, okay? We'll start it in the new year because we literally received the money in the last few weeks of the financial year. It's intended for the new year. Now that's true deferred income because the grant value is then deferred into the new year. It's very difficult when it comes to balances to actually determine how much of that income truly should be deferred, because basically it's just a balance and it's not an actual quantifiable liability. So it depends on your donors, not your donors, your auditors, and who the auditors are, whether they will allow the deferred income to show all your grant balances, or whether you need to use another method, depending on how strictly they hold to that liability definition. Right, so what we're doing is we're talking about donor balances and how we reflect them on the balance sheet. But how do we calculate the donor balances in the first place? So that's my next question to you, or rather statement. I'm not going to take time to let you answer that one. We'll take time at the end. This seems very obvious. Opening balance plus income minus expenses equals closing balance. I think if you've been done school accounting, I think you probably understand that. But you would be very surprised at the number of times that I've entered an organization and said, how do you know what money you're spending from the donor, whose money you're spending? And I get given a spreadsheet that has an export from the trial balance or the income statement, where you've got income and there's a column for each donor, and you put the income in there and the expenditure, and there's a column for each donor, and you put the expenditure in there in some calculation, and you get a closing balance. And my very first question is, where is the opening balance? Because there's always a carry forward from the previous year if you've got multi-year donors, or it crosses over the financial year, or you had 10,000 Rand from the last grant floating that needed to be spent. There's always an opening balance. And so often the templates and spreadsheets and things like that people develop don't include the opening balance. And it's partly because you have accounting systems that ring fence one financial year. And so you can extract from your accounting system a very nice clean picture for that financial year. Gabriel mentioned QuickBooks, and one of the advantages of QuickBooks is that you can run an income statement from the beginning to the current period. And so that essentially gives you accumulated income and accumulated expenditure per donor if you're tracking it that way, which will then give you a closing balance because it's including all the prior opening balances. But whatever your system is, just flag for yourself, please. Make sure you're tracking that opening balance, that you're making sure that the prior year's closing balance equals the current year's opening balance, and you're doing that. Otherwise, you end up with big surprises where there's money at the end that you're like, I don't know where this came from. So, okay. So when it comes to tracking donor balances, I really felt like we needed to define the types of organizations that because I think it matters how your organization runs and what it is that you are doing in how you are actually engaging with donor balances. So this is very big generalization, okay? Everybody is particular and has their nuances and their hybrid ways of working. But so this is just to give you a bit of a structure and a conversation to continue the conversation around. So one organization is where you have a core project or activity. It's like your reason for existing. This is what we do. And things like that are charity shops, children's homes, an educare center, right? Where you're not running programs, what you are is what you do. Okay, so that's the one type for this exercise. The next one is where you have a few repeatable programs. So there are a couple of our clients, Manessa knows some of these, that you have your main program areas. We address, and I don't really want to go into specific client examples, and those, when you look at your website, you've got a page for each of those program areas, or you've got a section for each of those program areas. Within your annual planning, those activities within that might change every year. So you might have different outcomes and your different focus areas, but so those specific activities will adjust depending on donors, depending on requirements, depending on planning, whatever it is needed, right? But you've got like, we do these 3 things, okay? Then you have those organizations that do bespoke programs. So they have a broader context of what we're trying to achieve. There's a broad goal, and then they create a program specific to that donor to meet the requirements of the donors. And these are organizations that are typically dealing with international donors and of a more sizable organization where they can actually custom make a program. It is typically a multi-year program. So Shannon, Michaelle, this is the kind of organization you guys are working with, where each program is specific to that particular donor and the requirements of that donor. Okay. And within that, the activities will be very different. And so you can't say we do, you might be able to say broad enough we do workshops, but you might not be able to say we do these types of workshops in every one of our programs. It's difficult to identify standard activities because they're all specific to the outcomes of that particular bespoke program. Okay, we're on the same page here, hopefully. Pick up your hand if you're not. Then the other thing to take into account is the correlation between programs and donors. Okay, so projects or programs. The nicest one, the one we love so much, is where you have one-to-one. And typically when you're looking at bespoke programs, it's a one-to-one, right? Donor funds that program, easy peasy, lemon squeezy. The one that is more complicated but doable is where you have one-to-many. So one program to many donors. So there's a specific program and there is co-funding that is required for that program. So you have at least 2 donors, maybe more, right? Any of you who've had EU grants, they only do co-funding grants. You at least have to contribute 10% from elsewhere, which can be your own funds, but there has to be a co-funding. But the project is distinct, and so they want reporting on the program, the project as a whole, including the co-funding source of income. Another one that we tear our hair out over is Bread for the World. And maybe you can just stick up your hand, or I just want to say a sad face or something like that if you have Bread for the World funding, because that'd be interesting to see how many of you have Bread for the World funding. They are a very flexible, supportive, multi-year donor, absolutely wonderful, but their project, which is often almost the entire organization, has to have co-funding. And so managing the balance between their funding and the co-funding can be a tricky exercise. Okay, the last one is then many to one. where you have one donor who says, here you go, have money. I will give you 100,000, 20, 20, 30 on your 3 programs. That's not 100,000. I can't do maths. I need a spreadsheet formula to do math. But you know what I mean? So you've got, let's say, 2 programs and you do 150-50 on the 2 programs, right? The donor is contributing to a variety of programs. So that's one-to-many, right? So bearing in mind the type of organization you are and the various types of donors, the correlation between projects and donors, we then have the last piece of the puzzle, which is the type of donor. Okay, and when I'm talking about type of donor in this particular context, I'm only talking about the reporting requirements of the donor. Okay, so I mean, there's lots of types in other contexts. So we have the ones that we love to hate, who require reporting at transaction level. Okay, so typically you're talking German donors, EU, things like that. They want to know every single transaction. They want to know that supporting documentation with a timesheet and a pay slip and, every little petty cash slip. They want to know all of the things, right? Incredibly detailed. So you get those horrible ones. And then you get the sort of slightly less horrible who also want a transaction list. And surprisingly, it's becoming more and more of a reporting requirement. Some of the ones who are more flexible have now started asking for a report on all the transactions. Okay, then you have project reporting. And I say project, there is not necessarily yours. Because say you have one of those donors who gives to many projects, to them, their project is project 1 and project 2, where they gave their 50 and 50, right? They want to know on their 100,000, which crosses your projects. So they need a report on that 100,000 as a total. Or if it's co-funded, right? Where it's a Bread for the World one, they want to report on the whole project, which isn't necessarily your project because they might have pieces of your programs in their in the thing that they are funding. And they don't need to know individual transactions, but they do want to know for the thing that they're contributing, the income and expenditure, and they're wanting that at a higher level. So in other words, it's a cutout piece of your accounting information. And then the last one, which is the nicest one, but can create problems, is your contribution funding. So these are donors who go, here, give us a budget for your organization budget, and you give them 5 million, and they say, here's to 500,000 towards your budget. Okay, and we're like, yes, we have quote unquote core funding. We have unrestricted funding. We can spend it on whatever we like. And they don't need a report. They don't need us to track it. They don't need us to check the balance of funds for them. All they need is your annual financial statements at the end of the year. So we love those people, right? Because we don't have to track it in so much detail. But there are challenges and we'll get there, okay? So is everybody clear with me so far on the types of projects, the correlation between projects and donors, and the types of donors and the reporting requirements? Because now we're going to get into the detail. All right. Next one. Okay. So this one is the easiest one. That's why I started with the bespoke, the core project, right? Because most likely, if you're an educator, you've got some corporate who said, here's 100,000 towards your organization. It's very unlikely that you're going to get transactional funding when it is a centralized one core project, okay? And then it's straightforward enough to just have an Excel spreadsheet where you make a judgment call at the end of the month on where you're going to allocate that income and expenditure in order to get a donor balance, okay? So it's as automated as you can get it. It's partially manual, and you're making a judgment call over where you're going to allocate the funding. So you've got salaries, you may say, well, we'll split it 50-50 between the donors. We may split it, you know. Okay, so I'll talk about the basis for allocations later. But really, an Excel spreadsheet is all you're going to need in order to report to your donors. I skipped over B, the repeatable programs, because we'll do it last, and looked at the slightly easier one of bespoke programs. So the donor typically will equal the program, even if there is multiple donors within that program, right? So often you will have a program set of accounts section in the accounts. So you've designed this for your client, the donor, and so you have a section in your books where you're able to say, these are the activities that we're going to do for that donor, or these are the group of activities, right? So Greta, there's a particular client of ours that we've worked with where they have those activities broken down within the chart of accounts, and they can allocate to those activities. So sometimes it'll be activity level because you don't want to go into like each individual workshop. They'll just put workshops as a whole total. For that, it is easy to allocate the transactions to a donor based on the individual transactions. So you're not taking like the core program where you've got an Excel sheet at the end of the month and splitting totals, saying we'll split salaries, 50-50. Here, you're actually saying, well, we need to report at transactional level, maybe, or even program level, but we can easily identify which transactions are attributed to a program and therefore to a donor. Okay, so if you're then taking your individual payment requisition, you're putting that section in the chart of accounts, the main account and the sub accounts, whatever, for that particular program, you're allocating that transaction directly to the program. When you come to reporting, you then can just extract that section and you can then report to the donor based on that section because you have that report recorded at transactional level. So there's some organizations that I know that can manage this, where then the challenge becomes shared costs, right? And so you may find that you would either use a chart of accounts or you can supplement by using a project code. So it's helpful for me to use Michaelle and Shannon's organization as an example. They have sections in the chart of accounts, but then they also use the funder as the project, as an analysis code, right? I say system project code, but sometimes it's a cost code, or it's an analysis code, or it's a class. That's what QuickBooks use. They're separated into classes. So you may then take that transaction and allocate it to a class as well. So you're able to then pull easily an income and expenditure report for the class or the project or whatever it is in your accounting system. And that tells us exactly which transactions have been allocated to that donor because it is allocated to the same program. All right, you're tracking with me. So then what do you do about shared costs? Typically, you're looking at salaries and overheads, and often there's a spreadsheet. So you then have to make some decision outside of the accounting system to say, we're going to allocate salaries in this way. And often it's determined by the grant agreement already. So you'll say, executive director, there's a 5% contribution towards, from this donor towards the executive director's position. There's a 25% to the finance manager. There's 100% to the program manager. The grant agreement has specified how that is calculated. And so we're then using either the percentages or the distinct values to be able to allocate that to the donor or to the program, because in this case, we are looking at the bespoke program. So we want to be able to say, what are the costs that relate to that particular program? And then the donor reporting flows from there. So there's a number of ways that we've done. This is a whole nother workshop entirely on its own. But things like charging the program using an internal invoice, charging the program based on a timesheet, based on a percentage level of effort, or sometimes based on the specific budget value. The donor gives you 10,000 Rand towards that position. Every month you bill, however you do that in your internal system, you bill the program for that fixed amount. So essentially you end up with individual transactions that are allocated to that bespoke program and a contribution towards the share costs that is typically a journal within the accounting system to allocate it to the program, or you do that allocation to the shared costs outside of the accounting system in an Excel spreadsheet, so that you have then a comprehensive picture for the program. The program equals the donor, so that then gives you the balance for the donor based on that information. Some people keep separate bank accounts for donors, different donors. If you do, then you have to be very cognizant of transferring funds between the bank accounts in order to align with how you have shared the costs as a total, right? If you keep all the money in one bank account, you have to be very clear on what is the balance of funds from each donor, because you need to know of your 10 million that's sitting in the account, how much is your money that you can spend without complying with a grant agreement, and how much is each particular donor's funds. Okay, so I haven't talked about bank accounts. There's only so much we can cover today. Okay, so that's a conversation around how do we allocate the shared costs. So then let's talk about repeatable programs. Okay, so you have variable activities within your programs. The donor doesn't necessarily equal your program. So you've got all sorts of combinations, right? And often what we'll find is that the chart of accounts is at program level. So you'll have a main account, typically, if you still use those, main account for program 1, main account for program 2, and then sub-accounts for travel, workshops, supplies, whatever. So the sub-accounts tend to be around the nature of expense, unless you are able to have them at the level of activity. But the challenge with activities is they change, right? And so each year you would have different activities, means adjusting the chart of accounts every year. So that's a decision that needs to be made as an organization. Okay, so when it comes to having repeatable programs, but you need to report to your donors at a transactional level, okay? Typically what we would do is we would create an analysis code for the donor. So a class or a project or whatever it is, okay? In the accounting system, because it's very difficult to do transactional reporting retrospectively. You have to actually have identified early on which transactions relate to that particular donor's agreement, okay, if you have transactional reporting. And I mean, I've recently had a situation where we've had to come in and fix things without handover. The finance manager resigned, and we're reporting at a transaction level to a donor, but I'm like looking at the ledger going, it's choose you, because we actually don't have the systems in place to have identified in advance which are the transactions that need to be reported to this donor as coming from their funds, okay? So the most critical thing when you have to report to a donor at transaction level is to have a system for mapping the donors to the activities and therefore the transaction. So let me use an example. Program A runs various workshops, but the donor only pays the workshops that are run in the Western Cape in these 3 activities. Okay, so in the donor report or donor budget, we've got activity 1, activity 2, activity 3. And those are 3 specific workshops that are only run in the Western Cape. So now you're getting payments coming through the system for venue, for travel, for participants per diem, for all sorts of things that are workshop related. But the organization runs workshops, that's what it does, right? They're for all sorts of things. How do you identify that this particular venue is for one of those activities that the donor is covering under their Western Cape grant agreement? That's a big question, right? That's a question that you as finance can't know with absolute certainty, because that's a program management question. That's a question that the program team need to look at their work plan and say, right, we are running, by obligation, we have to run these 3 workshops. One we're going to do in March, one we're going to do in June, one we're going to do in October, right? So when we get to March and they're preparing the workshop, they're contacting the participants, they're organizing it, they know that when I send you this invoice for the venue, that it relates to that particular workshop, right? They know that stuff. Whether they know who the donor is or not, that's a secondary question, because they're able to identify that particular activity. So you need to have some system that is able to, say, communicate from the programs team, these costs that need to be paid relate to that activity that is funded by that donor. Okay, and that's a huge training area for a lot of program people, because they're not naturally financial people. They're not naturally understanding all of these systems, but it's very difficult for a finance team who has this kind of structure and you're reporting at transaction level to know exactly where to put those individual transactions. There needs to be a system. Yeah, one of our clients has now got what they call the Gantt chart. The Gantt chart. It's like this central document that everybody's now using. And the Gantt chart has basically got all the activities, and it's timed by months and things like that for their work planning. It's got the cost of those activities, and now we're putting in the accounting code and the donor code, so that when they are planning, they know exactly that's the code that needs to go on all expenses related to that activity, and this is the donor code that needs to go on all of those activities as well. So then when we're capturing it in the accounting system, we're able to put it to the correct activity and put it to the correct donor at the transaction level. Okay. Can't see any noddings or any confused looks, because half of you have got your cameras off. Making sense. Okay. So the question then is for you on the number of donors that require transaction level reporting. Okay. Because if most of your donors just require an annual financial statement or an explanation of how you spent their 100,000, and you only have one donor that is at transaction level, then you may decide, I'm only going to allocate those individual transactions to a project code or a donor code, right? Because it's only important that those specific ones get flagged as, I need to record this as the transaction, right? So it's just a few transactions, it's not everything. There's a critical mass point where you say, look, everybody needs to know their individual transactions. Let's just make sure that we are recording every single transaction to the activity and to the donor code within the accounting system, so that we're able to extract that information when we need it. One of the advantages with QuickBooks particularly is that class system. and the classes and subclasses and all that sort of thing. So if you've got your chart of accounts set up well, it's a simple matter then just putting in the class, right? And same with Sage and even Xero, they have project codes. So the question is, do you want to put use the project code for donors? And if you do, then do you want to allocate every single transaction to a donor, or do you want to just allocate those ones that you need to specifically identify? So that's a decision that needs to be made as well. Okay. So where you've got project reporting, you can use Excel, right? Take the trial balance. You just need to know this program is, all the costs for this program. We can split it between the 3 donors that need to be reported on, because you're going to literally take the Excel column for that donor and say, here you go, this is how we spent your money. You gave us 100,000, we spent 20 on salaries, we spent so much on activities, we spent so much on so much. And you're just going to give them their little column in their own format. They don't need to know the underlying transactions that are behind that calculation, right? They're just needing to know the total income and expenditure for their project. So you can then take that into Excel. The nature is that the expectation is that you have your 3 programs as sections in your chart of accounts. The donor is covering 1 or more of those programs. Because it's allocated to the program, we know that then we can allocate it to the donor that covers that particular program. Okay. Right, so when you're considering allocations for donors, you then need to look at what are the activities that they cover, what are the timeframes. So we try to automate allocations in Excel as much as possible, but it requires judgment, right? And takes a moment to actually consider. If you've got a donor that crosses your financial year end, you want to spend the one that ends on your financial year end before you spend the one that crosses, because you can then make up in the new year. So when are the time frames? Who do you need to spend first? Which one finishes first? Those are the ones that you need to spend first. Have you got the cash? Is the money in the bank? Because you can't spend the money if you don't have the money, unless you have specifically got an agreement with them that you can. And you have adequate other funds that are not restricted that you can use to front that money for the donor. What is the size of the donor grant? Because typically the small ones are restrictive in that there's very little flexibility. So you want to spend those small ones quickly, and then in the bigger ones you can say, well, can we extend it? Can we move money between line items? Can we be more flexible about that? So the size of the grant also matters in your consideration of whose money you're spending first. And then also it comes down to flexibility and the budget variances. So a lot of the donors will have a cap. You can only exceed the budget by 20% or 15%. You need to get approval for variances over 10% or whatever it is. So you need to allocate rigidly to those donors that have very strict requirements. And then the ones that are more flexible, then you can take up the slack and can be over and can be under and can you have some room there to allocate whatever else is outstanding. And then there's also extensions. If you're not going to be able to spend the donor's funds, can you extend it? When you have multi-year grants, then it's much easier to extend, or at least to then plan to spend the money in the remaining years. So the rule of thumb is always to start with the most restrictive donors, and to then move on to least restricted, because then we can, they kind of fill up the gaps. Okay, so the last one we've spoken about in types of funding is contribution funding. Okay, where they give you a lump sum contribution. And everybody's like, this is great, it'll fill the gaps, but we don't track it, okay? And so what we've had with the situation with Bread for the World, because this is across many of our clients with Bread for the World, they're like, Well, Bread for the World, so the project is 2 or 3 donors, and Bread for the World will cover, let's say, 25%. It's a fixed percentage that's dependent on your agreement, right? So you've got to make sure that their amount of money that they're giving you, 100,000 euros over 3 years, is always 25% of the expenditure, which means your expenditure has to be higher or lower to make that percentage work, okay? At the beginning, you go, well, that's fine. Bread for the World will just pick up the difference because they're not covering line items. They're not covering transactions. They're covering whatever is in the grant, in the project. But the problem we've had is that as more donors get added to that agreement, because when you start the agreement for 3 years, you don't always know where your co-funding is coming from. You estimate an amount of co-funding, and then you get extra co-funding. And so while you knew that Bread for the World will cover, most of the salaries, now you've got donors, restricted donors, who are covering portions that Bread for the World used to cover, which means that now you're not going to spend all of Bread for the World's money. And so typically in year 3, there's this big scramble and we have the spike of activity in order to spend all the money because we don't want to leave money sitting in Germany. That's like, nobody wants that. So internally, we actually have to track how much of Bread for the World's money are we spending out of that project, take that project with the co-funding and separate it into its component funders to be able to know when somebody else is now funding more salaries, that frees up money from Bread for the World for activities. So then we actually have to have specific designated activities for that contribution funder who is just giving us money towards the pot. Because if other people give us money towards the pot, then we need more work to be done. So despite the fact that it's a lovely contribution to whatever we want to spend it on, we actually need to track it. And we need to track it at a fairly detailed level in order to make sure that we are on the same page. Okay, the last one, which I realize I didn't actually do a slide for, is fund accounting. So what some people do is put the money when it comes in, they put it on the balance sheet. Then as they spend in the year, they will then do a transfer of income to match the expenditure so that the balance sits on the balance sheet on the fund. So the issue with that is it sits as a liability, but it's not really a liability. It's funds that have been received. The other problem I have with that is that you have to be very explicit about whose money you're spending at any point in time, right? You have to track that very carefully because you're then doing a transfer from that fund on the balance sheet into income to make it zero. If any of those figures change, it's no longer zero. And so you're now having to then do more journals to correct the more things. So as much as it's possible to be done in Excel, it gives you flexibility to change things and to make those changes, because anything that's done in the accounting system requires a journal to correct it or to go in and make changes, which impacts the reporting and So we don't really want to make changes into prior periods. And so you end up with challenges if you're trying to match it off perfectly. So those are some of the things to consider. I think to sum it all up, it's never the same. Every organization is different. It's often hybrid. So I've kind of like mapped out the three areas that you would have and the different types of donors. It's always complex. It's like, I can see, like I can imagine your faces are going, okay, well, what does this mean for me? How do we work this out? It's a puzzle. To me, that's fun. To some people, that's hell. But it is a matter of seeing what are the requirements of your current donors, what are the potential requirements of future donors, how are you able to gather information from your program team to support how things are allocated, what are the systems, the accounting systems, the Excel spreadsheets, things like that we can build that will facilitate this so that it makes it easier for us to do donor reporting and to know exactly at any point in time how much money we have of each donor, because that's a critical piece of information. And this is a particular aspect that we have as nonprofits that you don't have in business. In business, they don't care how what your surpluses, who they come from, and how the donor, that's not a question, right? So this complex aspect is something that as nonprofit finance team, we really need to engage with and work out what works best for you as an organization.